Assalamualaikum and good day everyone. I am Asnarisa Parkinson and this is the third part of our report, the Chapter 1, Auditing and Internal Control. So first, let's define what is an IT audit. An IT audit is the examination and evaluation of an organization's information technology infrastructure, policies, and operations. Information technology audits determine whether IT controls protect corporate assets, ensure data integrity, and are aligned with the business overall goals. IT auditors examine not only physical security controls but also overall business and financial controls that involve information technology systems. So, because operations at modern companies are increasingly computerized, IT audits are used to ensure that information-related controls and processes are working properly. So, there are four primary objectives of an IT audit. So, these are first, evaluating the systems and processes in place that secure company data. Second, determining risk to a company's information assets and help identify methods to minimize those risks. Third, ensuring information management processes that are in compliance with IT-specific laws, policies, and standards, and determining inefficiencies in IT systems and associated management. So, an IT audit focuses on the computer-based aspects of an organization's information system, and modern systems employ significant levels of technology. So, for example, transaction processing is automated and performed in large part by computer programs. So, similarly sourced documents, journals, and ledgers that traditionally were paper-based are now digitized and stored in relational databases. So, as we will see later, the controls over these processes and databases become central issues in the financial audit process. So, the public expression of the auditor's opinion is the culmination of a systematic financial audit process that involves three conceptual phases, that is, audit planning, test of controls, and substantive testing. So, the figure you are seeing in the screen illustrates the steps involved in these phases. So, through each phase of an audit, evidence is accumulated as a basis for supporting the conclusions reached by the auditors. Audit evidence is proof of the fairness of financial information. So, we will explain these three conceptual phases one by one. So, the first step in the IT audit is audit planning. A major part of this phase of the audit is the analysis of audit risk. So, the auditor's objective is to obtain sufficient information about the firm to plan the other phases of the audit. In this phase of the audit, the auditor also identifies the financially significant application and attempts to understand the controls over the primary transactions that are processed by these applications. So, during the planning phase of an audit, the auditor must gain a thorough understanding of the company's business and financial reporting systems. In doing so, auditors review and assess the risk and controls related to the business, establish materiality guidelines, and develop relevant tests addressing the assertions and objectives. Having done so, the auditor proceeds to the next phase, where he or she tests the controls for compliance with pre-established standards. At this stage, the auditor will consider what are the key controls in the internal control of purchase. Then, the auditor needs to test those key control. In other words, the test of controls in purchasing from the beginning process to the ending process. So, the objective of the test of controls phase is to determine whether adequate internal controls are in place and functioning properly. So, to accomplish this, the auditor performs various tests of controls. So, the evidence gathering techniques used in this phase may include both manual and specialized computer audit techniques. As previously explained, the degree of reliance that the auditor can ascribe to internal controls will affect the nature and extent of substantive testing that needs to be performed. At the conclusion of the test of controls phase, the auditor must assess the quality of the internal controls by assigning a level for control risk. So lastly, the third phase of the audit process focuses on financial data. This phase involves a detailed investigation of specific account balances and transactions through what we called substantive test. So for example, a customer confirmation is a substantive test sometimes used to verify account balances. So here, the auditor selects a sample of accounts receivable balances and traces these back to their source, which is the customer, to determine if the amount stated is in fact owed by a bona fide customer. So by doing so, the auditor can verify the accuracy of each account in the sample, and based on such sample findings, the auditor will be able to draw conclusions about the fair value of the entire accounts receivable asset. So, some substantive tests are physical and labor-intensive activities. These include counting cash, counting inventories in the warehouse, and verifying the existence of stock certificates in a safe. In an IT environment, the data needed to perform substantive tests like accounts balances and names and addresses of individual customers are contained in data files that often must be extracted using computer-assisted audit tools and techniques software. So these techniques refer to the use of technology to help you evaluate controls by extracting and examining relevant data. So we will examine the role of this technique in performing traditional substantive tests and other data analysis and reporting tasks in the latter part of this chapter by the next reporter. Okay, so next we have the internal control. Internal control is a process affected by the entity's board of directors, management, and other personnel designed to provide reasonable assurance. Organization management is required by law to establish and maintain an adequate system of internal control. So, the Securities and Exchange Commission states that the establishment and maintenance of a system of internal control is an important management obligation. A fundamental aspect of management's stewardship responsibility is to provide shareholders with reasonable assurance that the business is adequately controlled. Additionally, management has a responsibility to furnish shareholders and potential investors with reliable financial information on a timely basis. Nonetheless, the responsibility was made explicit in Sarbanes-Oxley. Section 404, which will be discussed later, specified that the Commission was to adopt rules stating the responsibility of management for establishing and maintaining an adequate internal control structure. In addition, the rules were to provide for an assessment of the effectiveness of the controls by the company's auditor. So let us now move on to the brief history of internal control legislation. So accountants are key participants in ensuring control adequacy since much of the internal control system relates directly to transaction processing. This section begins with a brief history of internal controls and then provides a conceptual overview of internal control and causal control framework, which will be further discussed by the next reporter. So first, we have the Securities and Exchange Commission Act of 1933 and 1934. So here, the U.S. legislature passed two acts to restore confidence in the capital market following the stock market crash of 1929 and a worldwide financial fraud by Ivar Krueger. The stock market crash happened on October 29, 1929. That is when Black Tuesday hit Wall Street as investors traded some 16 million shares on the New York Stock Exchange in a single day. So here, millions of dollars were lost, wiping out thousands of investors. So the next day, the panic selling reached its peak with some stocks having no buyers at any price. So first, is the Securities Act of 1933, which had two main objectives. That is to require that investors receive financial and other significant information concerning securities being offered for public sale, and second, prohibit deceit, misinterpretations, and other fraud in the sale of securities. So, the second act, the Securities Exchange Act of 1934, created the Securities and Exchange Commission and empowered it with broad authority over all aspects of the securities industry, which included authority regarding auditing standards. So the Securities and Exchange Commission Acts also required publicly traded companies to be audited by an independent auditor such as a certified public accountant, and also required all companies that report to the Securities and Exchange Commission to maintain a system of internal control that is evaluated as part of the annual external audit. So next, we have the Copyright Law of 1976. So this Copyright Law of 1976 had multiple revisions. The Copyright Act of 1976 forms the basis of copyright law in the United States today. So it took effect on January 1, 1978, implementing fundamental and sweeping changes in many aspects of copyright law. So copyright protection extends to all original works of authorship to take into account new kinds of media. So this law added software and other intellectual properties into the existing copyright protection laws. It is of concern to IT auditors because management is held personally liable for violations like software piracy if raided by the software police and sufficient evidence of impropriety is found. So next, we have the Foreign Corrupt Practices Act. So this act is a United States law that prohibits U.S. firms and individuals from paying bribes to foreign officials to further business deals. So corporate management has not always lived up to its internal control responsibility. So with the discovery that U.S. business executives were using their organization's funds to bribe foreign officials, internal control issues, formerly of little interest to stockholders, quickly became a matter of public concern. So from this issue came the passage of the Foreign Corrupt Practices Act of 1977. Among its provision, the FCPA requires companies registered with the SEC to do the following. So first is to keep the records that fairly and reasonably reflect the transactions of the firm and its financial position. And second, maintain a system of internal control that provides reasonable assurance that the organization's objectives are met. So this act has a significant impact on organization management, with the knowledge that violation of the FCPA could lead to heavy fines and imprisonment. Managers have developed a deeper concern for control adequacy. Okay, so next is the Committee of Sponsoring Organizations, or the COSO. So following the series of savings and loan scandals of the 1980s, which was the first large banking crisis after the Great Depression, a committee was formed to address these frauds. The crisis resulted in thousands of savings and loan institutions closing and billions of dollars lost, hurting customers and taxpayers. So originally, the committee took the name of its chair, Treadway, but eventually the project became known as Committee of Sponsoring Organizations. So This CASA is a private sector initiative established in 1985 with the intent of improving the quality of financial reporting through a focus on corporate governance, ethical practices, and internal control. So its mission is to help organizations improve performance by developing thought leadership that enhances internal control, risk management, governance, and fraud deterrence. So the sponsoring organizations included Financial Executive International, the Institute of Management Accountants, the American Accounting Association, AICPA, and the IIA. So, the committee spent several years promulgating a response because it was determined early on that the best deterrent to fraud was strong internal controls. So the committee decided to focus on an effective model for internal controls from a management perspective. So the result was the COSO model. So, this COSO framework is a system used to establish internal controls to be integrated into business processes. So, collectively, these controls provide reasonable assurance that the organization is operating ethically, transparently, and in accordance with established industry standards. So, the AICPA adopted the model into auditing standards and published Statement on Accounting Standards number 78, or the consideration of internal control in a financial statement audit, which states that for purposes of a financial statement audits, auditors generally limit their understanding of safeguarding controls to those that are relevant to financial reporting. Okay, so lastly, as a result of several large financial frauds including Enron, WorldCom, Adelphia, and many more, and the resulting losses suffered by stockholders, pressure was brought by the U.S. Congress to protect the public from such events. So this led to the passage of the Sarbanes-Oxley Act of 2002. So the Sarbanes-Oxley Act of 2002 is a federal law that established sweeping auditing and financial regulations for public companies. So lawmakers created the legislation to help protect shareholders, employees, and the public from accounting errors and fraudulent financial practices. So in general, the law supports efforts to increase public confidence in capital markets by seeking to improve corporate governance, internal controls, and the audit quality. So, in particular, this act requires management of public companies to implement an adequate system of internal controls over their financial reporting process. So this includes controls over transaction processing systems that feed data to the financial reporting systems. So management's responsibilities for this are codified in sections 302 and 404 of the SOX. So section 302 requires that corporate management, which includes the CEO, certify their organization's internal controls on a quarterly and annual basis. Section 302 also carries significant auditor implications. Specifically, external auditors must perform the following procedures quarterly to identify any material modification in controls that may impact financial reporting. That is first, interview management regarding any significant changes in the design or operation of internal control that occurred subsequent to the preceding annual audit or prior review of interim financial information. Second, evaluate the implications of misstatements identified by the auditor as part of the interim review that relate to the effective internal controls. And lastly, determine whether changes in internal controls are likely to materially affect internal control over financial reporting. Okay, so in addition to Section 302, Section 404 requires the management of public companies to assess the effectiveness of their organization's internal controls. This entails providing an annual report addressing the following points. That is, first, understand the flow of transactions, including IT aspects, insufficient detail to identify points at which a misstatement could arise. Second, using a risk-based approach, assess both the design and operating effectiveness of selected internal controls related to material accounts. Third, assess the potential for fraud in the system and evaluate the controls designed to prevent or detect fraud. Fourth, evaluate and conclude on the adequacy of controls over the financial statement reporting process. And lastly, evaluate entity-wide controls that correspond to the components of the COSA framework. So regarding the control framework, the Securities and Exchange Commission has made specific reference to COSO as a recommended model. Furthermore, the Public Company Accounting Oversight Board Auditing Standard Number 5 endorses the use of COSO as a framework for control assessment. Although other suitable frameworks have been published, any framework used should encompass all of COSO's general themes. So, um, that is all for my report. Thank you.